Time for our deep dive, and this time we're looking at Eternal. It has underperformed the benchmark this month, falling nearly 10%. That's the stock price, even as the Nifty holds steady. Now, the debate on the street is heating up. Strong cash reserves and bullish growth commentary on one side, rising competition and stretched valuations on the other. To break down the bull versus bear picture and telling us what brokerages are signaling, let's go across to Mahima.
Right. So, as you rightly mentioned, if you take a look at how the benchmark has done in the past 1 month versus the Eternal's performance, Eternal has fallen around 10% versus Nifty being almost flat, seeing gains of about 0.3%. And there are a couple of reasons as to why this has happened. Competition, of course, is one of the reasons. So let's take a look at the bull versus bear case as to what's happening with Eternal. Firstly, the cash balance as of Q2 FY26 stood at that 18,300 odd crore, post which we've seen Swiggy come out and say that they're going to raise around 10,000 crore via QIP. And once this 10,000 crore is done, even Swiggy will have a cash balance of around 14,000 odd crore. So, till now the debate was that whether Swiggy will be able to catch up in terms of where cash burn stands. And now after the fundraise, it will be able to catch up with Eternal where cash burn is concerned. The next point being, in terms of where the guidance stands, the company has said that they will double the net order value for their quick commerce business by FY27. But if you take a look at how the competition has been faring, there's aggressive competition. Flipkart, Amazon coming into the race in a very big way. Of course, still, only in some parts of India, but that is going to hamper the business going forward, and cash burn is very likely to be higher in the next few quarters. In terms of the quick commerce side of business, the gross order value growth is on the rise. But if you take a look at the food delivery segment, the growth has been declining for the past 5 odd quarters. In terms of Blinkit, the operational metrics have been improving both in terms of order value as well as in terms of the overall basket value. But in terms of peers, they are increasing the discount. Last time when the festive season discounting survey was done, the discount was as high as 23%, which was being offered by something like a Flipkart Minutes. In terms of where ANR stands, there are 28 buy calls with return potential of 16% right now as per Bloomberg consensus estimates. But at the same time, valuations were never cheap for Zomato, and going forward also till FY27 estimates, valuations are not looking cheap. Now, despite of all of this, we've seen brokerages come out and hike the target prices in the past 1 or 2 odd months. We've seen that Morgan Stanley yesterday did come out and maintained overweight with a target price of 427, which is the highest amongst all the target prices so far given by so many brokerages. You also had Bernstein that had initiated outperform with a target price of 390, and Citi also did come out with a note saying that they maintain buy and have hiked the target price to 395 from a 320 earlier. So this is the overall view as to what's happening with Zomato. Though we are seeing the stock tanking around 10% in the past 1 month, brokerages still remain bullish.
And that's what the interesting part is. The stock performance and the brokerage outlook is in clear contrast. Thank you for that, Mahima. Rahul Jain, Director Research at Daulat Capital, joining in to talk more about it. Rahul, very good morning to you. Hopefully you've heard that presentation that Mahima put across. Your view on Eternal and how it is being viewed by analysts. Clearly forward-looking, but is there that much value still left on the table for investors right now?
Good morning. We have a negative view, as we have highlighted earlier in your show as well. We think the challenge here is that the profitability path is going to be elongated the way the competitive intensity is shaping up in this space. So that would eventually lead to more and more people believe that the current valuations are a bit stretched, and the near-term return in the stock would be difficult to achieve. And that's how we would see, as it would test patience in terms of the profitability estimate, which on a consensus basis is already coming down for the last 12 months, will keep getting down as the year progresses. And that's how the view could possibly evolve in a consensus negative view over a period of time, is what we think.